Welcome back to our YouTube channel. People start up companies on a daily basis, and of course, there are existing companies that are still growing. And there are lots of people who put in so much effort in making this company grow. Companies don't just grow like that; they grow based on the input of lots of people. So that's why today we're going to be talking about understanding sweat equity in a business and how it works. Sweat equity. What is equity? First of all, equity means your stake of ownership in a business, the extent of your interest in a business. So every company has shares. So the number of shares you have in the company determines your stake in the company, and it also has a lot to do with your voting power, your say basically in the company. So if a company has, let's say, 100 shares and you have 50%, you're a major shareholder in that company. So if you have 50%, someone else has 10, the other one has 20, the other one has 10, the other one has 5, the other one has 5. You are the majority shareholder and you more or less control the company. So these shares are bought by money. So first of all, when a company is established, the company people subscribe to the shares. Those are the initial shareholders. All right. Now, in starting up the company and in growing the company, people spend their time, people spend their efforts, their intellectual capacity, and the company may not be able to pay them for that really. And there are some persons who have done everything possible to make sure the company succeeds. So the company now says, okay, you know what? How do we reward this person? Ordinarily, you buy ownership in a company. You buy into a company. If you want to be a part owner, you buy shares. And what do you use in buying things? You buy things with money. You buy shares with money. Shares are properties, although they are choices in action. That means they are intangibles, but they are properties capable of being owned. So if you want to buy them, you're supposed to pay money. But sweat equity now says instead of collecting cash, this person is now paying for the shares with his sweat. So that's why it's called sweat equity. So it's a term that refers to a person or a company's contribution towards a business venture or other project. The reason why I say a person or a company is because an individual can be a shareholder in a company, then another company can also be a shareholder in another company. So sweat equity is generally not monetary. It's not monetary, and it is generally physical labor, mental effort, and the time you have invested. So how does it work? Do you just wake up and say, "Oh, this guy comes to work every day. He stays late at night, and then he goes home very late. He brings lots of work to the office. He does this and that. For that reason, let's give him 50%." It doesn't work that way. So there must be a way to value, all right, to value the effort that is to be converted to shares. All right, so that is why there has to be a valuer. And for there to be a valuer, there have to be KPIs. KPIs refers to key performance indicators. So you have to have a standard, a yardstick to say, this is what an individual should contribute. This is how we assess your contribution. And this is how we determine what that contribution amounts to in terms of ownership. All right, so there must be a valuation, and under general corporate law, what normally happens is that there's an independent valuer that comes to value the contributions based on the KPIs already set by the company. So it is valued and matched together, and the individual concerned, based on the valuation report of the valuation of the valuator, is given the shares as sweat equity. So they're saying, don't pay cash for these shares. Your contribution has already paid for it. Don't pay cash for these shares. Your effort has already paid for it. All right. So that is basically what sweat equity is. Sometimes promoters of companies at inception take sweat equity. So when they subscribe to shares, they actually don't pay monies into the accounts of the company as the consideration for the shares they've subscribed to. So they take those shares as part of the efforts or as a return for the effort they have put into establishing the company. So what that means is that they were the ones running around to get to get the person that will register the company. They were the ones going around exercising their mental capabilities to get a name for the company. They were the ones who ran around to get the first investors. So they've been the one on the field trying to establish the company. So when the company is established, those promoters, those first guys, they come up as subscribers. And sometimes they can just say, you take 50, you take 50. All right. Particularly under the new karma where you only have issued share capital. You can't have shares that you have not issued, that you are not allotted. Everything has to be issued. All right. So now they just say, you take 50, you take 50. Did they pay for it? Not really. So for them, the effort they use in opening the company is what they used in paying for those shares. So when the company continues to grow, they can now say, oh, let's increase our shareholding and give new shares to others. Or the shares we acquired at inception, let's start selling part of those shares in exchange for cash. Okay, so basically, I believe this has been helpful. This is basically how sweat equity works. It is equity gotten for consideration other than cash for the effort you have put into the company, the work, your time, your intellectual capacity. So you're not paying for the shares with cash. You're paying with your efforts, with your time, and with your contribution. I hope this has been helpful. If yes, please click on the subscribe button so that we can give you more videos. Like the video, share the video, and drop your comments. Thank you for your time.